Good evening, everybody. My name is Eng Teng, the CEO, founder of Tozy Capital. And Tozy Capital has been sort of a culmination of all the experiences I have with investing, primarily real estate investing. But I've also been in equities investors for quite a while, and Shiv has been as well. In fact, in many cases, Shiv, you know, really lapsed me with his knowledge with equities in the equities market. That's why I'm very excited for Shiv to join me today, especially considering his background in working at early stage startups, where these topics are very relevant. And I've also been personally investing in pre-IPO shares and other ways to invest in asymmetric off options. Because I think real estate is a great investment. I love real estate. I love the predictability of real estate, but sometimes you want to have a little balance and diversification in your portfolio. And so that's why I want to continue to provide everybody the opportunity to understand all these alternative investments and really just highlight what's available and provide knowledge where we can. So always happy to answer questions as well. With that, I will start the presentation.
I think I can see your slides. They're good.
Okay, good. Thanks. So we're talking about today investing in private companies with sort of a direct investment model mostly, but then we'll talk about pre-IPO shares. I'll talk about the traditional IPO process. So what is an IPO? We'll talk about that. Direct listings, which is a new form of essentially public offerings. And then Shiv will take us home with Spacs. So a little bit about me. My background is in economics and finance. Went to Wharton, was an investment banker, probably my most related field on this topic. But I've also had many different careers, but I've also been very focused as an investor for quite a while. And with Tozy Capital, we have 140 million of assets under management. And so we are excited to offer real estate investments as well as private equity and pre-IPO shares on occasions, where we find some pretty good opportunities to do so. Shiv, would you like to?
Hey everyone, again, I'm Shiv Jayaraman. I am a computer science graduate. The last 20 years of my life, one part of it has been spent purely on video codecs. How does video encoding happen? How does video decoding happen? How do you stream video across the internet? So that's what I've been doing. But I've also been lucky that my first real job was actually as part of a startup. I was one of the earliest employees of a very small company back in India called Mindtree Consulting. For people who happen to know it, they eventually went public in 2007. And if you've taken a look at the stock price, what's happened in the last 20 years to this company, it's a very interesting journey. When I left them, if I remember correctly, they were 15,000 people strong. And I think when I was there were less than 100 people in the company. After that, I joined another company called Modulus Video. Again, one of the big guys in the video encoding industry. Modulus Video got eventually bought by a series of companies. Good exit there. Finally, we landed up with Google. I was also a product architect at Akamai Technologies, again, doing a lot of video stuff. And before I retired from the tech industry, I was a Facebooker, again, working on videos. But more importantly to this conversation today, I'm a very active private equity investor, and I hope to bring my thoughts on what I feel about Spac, what Spacs are. And I'm also a very, very avid real estate investor, commercial real estate investor. Thanks, Eng.
Thanks, Shiv. So investing in private companies. I think there's a few ways that we want to highlight. And I think the most common way for us, and I assume a lot of us here are in the Valley, and me being a former tech employee as well as obviously Shiv, what he's highlighting, it's working with startup, and you get compensated with shares of the startup, and that's a bet you make that could turn out very well. I have lots of friends at DoorDash and Airbnb that will tell me all the time that you should take in the offer when I try not to do the math, but those are the kind of things that is available for talented folks. But it's a lot of hard work, and the risk reward often doesn't necessarily make sense. You can be a venture capitalist, or you can invest in VCs. But if you're going to invest in a VC fund, you're probably going to want to do it in the top 10 because those get all the best deals, probably top 5. And then you can also buy pre-IPO shares, which on occasions is available to some retail investors or the really high net worth investors, and it's a very private market, but it's a very nascent market. And then you can also invest in Spacs, which share for cover. It's been around since 1990s, but only been really prominent in the last year. So what are pre-IPO shares? Well, buying a pre-IPO share is really just investing in one of the funding rounds of a company in sort of an interim funding round. With these funding rounds, you typically have to be you have to be sort of an institutional investor, or you have to have been an early stage investor, because those get really the best dibs of it. And so oftentimes these rounds get oversold, so that pushes up the value. There's a secondary market on occasions where private platforms and credit investors can buy shares of private companies from investors, from investors or from employees, as they potentially seek some liquidity, as they've been there for a while, or they've been investing there for a while, and they, that horizon, potentially they're trying to look for early liquidity. So those things happen on occasions. It's not very common. And of course, all this accumulates in an IPO, where it then becomes fully liquid and your shares can be traded at will, pending a lockup period, of course. So with traditional IPOs, I think that's one of the things that I've, as investment banker in the past, and taking some companies public, choosing an underwriter is one of the big parts of it, and that's really choosing an investment banker to get paid a lot of money. I've been in that side of things, but they play a critical part in making the IPO successful. Then you have to do the due diligence. It's a lot of SEC filing, and for those who invested with us in real estate investments, we actually use a lot of the same paperwork in terms of the private placement memorandums. It's all very similar. We do an SEC filing as well. So IPO is actually a very similar process. So when I read some of these things, I think, yeah, it's very familiar. And of course, there's a roadshow. It's really, everything is about selling here. And investment bank will go to their clients and then pitch the latest IPO, as well as try to push up the pricing, because of course they get paid on that commission basis. And then they set the IPO price, which could be most likely, potentially undervalued if they're trying to see, trying to show the market that there's going to be a huge demand. So they might undervalue, sort of like just pitching or listing your house below market to get a lot of bids to really show a huge demand. And then of course going public. So this stage actually takes quite a while. And for most private companies, it's something that you will want to consider to get a lot more capital access, as well as find creating liquidity for your early shareholders and investors. So the role of underwriters, and this is something that our team does in a little bit with our investments, which is mostly real estate and other types of private equity. One of the things people ask is, are they worth it? I think for a lot of folks, they are the main experts. They're the king of paperwork. There's a lot of paperwork in this space, and for folks in tech and startups, or any small business or any business that want to go public, that's a lot. That's just a lot of legal paperwork, and I'm very familiar with that, doing it for our investments. But they also have a deep investor network. Typically, if you're Goldman Sachs, you have a lot of private wealth, high net worth investors that want to be early in as well, or just want to just pitch to fund managers to buy up the shares on IPO. Now, a lot of people will say that underwriters make all the money, which is true. They quite a bit of money. It's this sort of the whole ecosystem that IPOs. It's really very favorable for, when you have a lot of IPOs, you look at Goldman Sachs as like, that's a very profitable company, because those guys are getting a lot of that. Their cronies get preferential treatment. I think that's the case for most things. You generally find, if you're an insider, you get a lot of preferential treatment. And there's no such thing as insider trading at this stage. it's only when you go public. The discount growth spread they can get on stock are very high, and the costs are kind of unwarranted. Um, so there's a lot of pros and cons of hiring underwriters, and that's why on occasions companies do look at outside sort of this traditional IPO market, where a world without underwriters is even possible. I think that's something that if you're looking to do a Spac or IPO, you're gonna have to go through all these bankers and then pitch them. They're gonna have to do a lot of due diligence. I've seen that happen. I've been on the other side as well. So I think there's a new case for direct listing your shares of a company. One of the things that has been very interesting is there's a lot of really famous private companies. If you are a Spotify and you're not public yet, why would you pay sort of the high fees to gear for an IPO or a Slack when you can just do a direct listing? Of course, there's some difference there, but that's sort of one of the values if you are really a famous brand to consumer products or consumers and to financial analysts. And so with traditional IPOs, new shares are created to raise capital. This leads to dilution of the current shareholders. Underwriters play a huge role. There's typically a lockup period for employees and pre-IPO investors, although that's not necessarily uniform. Underwriters work towards stabilizing the share after it goes gone public. And if companies do not command a brand presence, the IPO roadshow plays a critical role in creating interest. It's a lot of selling, guys. With direct listings, still a lot of selling, but it's just no new shares created. Capital raise is not the primary intent, and increasing liquidity for current investors is the focus. And I remember I was working at Apple Music when Spotify announced the direct listing, and it was very fascinating because I knew a lot of folks who joined Apple Music from Spotify and vice versa. And so it's always interesting to hear those stories. There's no underwriters involved, save a lot of fees there. No lockup period for employees because it's essentially creating liquidity for current investors and employees. Typically, companies that opt for direct listing have a strong brand. As I said, Spotify, Slack come to mind. But there could be huge volatility in share price. But as Spotify showed with the direct listing, it has been pretty big, resounding success, though hard to potentially replicate with maybe more unknown brands. So, I think direct listings, that sort of, Spotify is an unqualified success based on all the metrics, whether that would be potentially a viable alternative to underwritten IPOs. I think there's a lot to be said there. One thing I'm not talking about this whole presentation is ICOs and tokenization. That was something that we'll probably touch base on another topic of DeFi. But it's still all about creating liquidity and capital and getting access to capital markets. And so direct listing, IPO are very similar, but have different routes to take. Shiv, what are you talking about the back?
Awesome. Thanks. Thank you so much, Eng. Seems to be a great moment actually, because what I was going through all day today is I had a power cut at home. They were just redoing all the cabling around our home. And right when Eng passed it on to me, I seem to have got my electricity back. But still, Eng, I'm looking towards you to let me know if I'm actually lagging off or I'm getting cut so that I could switch to a better Wi-Fi. I'm leaving it on 5G for the moment.
Okay.
So let's talk about Spac. But before we actually get into discussions on Spac, let's actually step back and discuss why are we talking about this in the context of Tozi Capital, right? Because there's something that Eng constantly talks to me about and he strongly believes in. If you just go Google Spac today, I'm sure for every 10 instances of articles which say Spacs are the next best thing to happen after whoever, you will find 10 other articles which say Spacs are a scam. Now, this is what typically happens when a new investment vehicle or methodology comes into the fore. And Eng has always believed, and that's the reason why I truly respect Eng and have long conversation with him, is he says, before you start judging anything, why don't you take the effort to understand what it is all about? There could be scammers, there could be awesome people, but the truth is always somewhere in between, that any investment vehicle is actually a well thought out investment vehicle which serves a particular purpose. As investors, it is our responsibility to understand the true motivation and purpose behind an investment vehicle and stay true to it. Steer clear of the scammers, steer clear of the crazy guys who are making billions every morning, and try to walk that middle path where you can make sane investments. And this is possible if you understand what the purpose behind a SPAC is. So my job over the next 20 minutes would be to talk to you about what is a SPAC, what's the purpose, what's the scope, and what are some of the stories that's happened when it comes to SPAC over the last 18 months, because it's a very interesting period as far as SPACs are concerned. Now, a SPAC is a short form for a special purpose acquisition company. It's also called a blank check company. If you just Google a blank check company or a SPAC, they essentially mean the same. So we're going to be talking about what a SPAC is, how is it formed, why is it formed, and what is its scope, and how you can take advantage of it. Next slide. And as always, if my voice is trailing off, please let me know. Now, why is everybody talking about SPAC? Whether it's a virtual meeting that I have with my investor friends or it's an in-person meeting, the first question that anybody's asked me in the second half of 2020, or people have asked Eng, is, have you invested in a SPAC? What do you think about SPACs? Should we get into SPACs? And that came into the forefront in the second half of 2019, when a SPAC from Chamath, and Chamath is my ex-colleague at Facebook, but way up in the hierarchy, he left and he started a SPAC. He started a whole bunch of SPACs, in fact, and one of his IPOA, the name of the ticker of the SPAC, bought a small company called Virgin Galactic. Right? Everybody knows about Virgin Galactic, what was happening. So this became big news. And before you knew it, SPCE, the ticker, was now a new public ticker, and everybody could invest in it. Nobody could understand how Richard Branson, over a fortnight, could go from a private company to a public company with his own ticker. Did he go through all his SEC filings? What happened with all the regulations? There was so much confusion, but it was considered the biggest advertisement for SPACs. Then came DraftKings. For people who follow DraftKings as a stock, it's very interesting. And then the last one, I'm sure everybody here would have at least dabbled with it, heard of it, or knows a friend who bought a Nikola share. And Nikola is in the electric vehicle sector, and Nikola went public using a SPAC merger as well. So when all these news started floating in, people started putting more interest, putting more focus on understanding what a SPAC is, and that's what we're going to read through. As I go through these presentations, at any point, do stop me if you feel that you do not understand a particular concept, and I'll try my best to throw some light on it. Next slide. So why is SPAC interesting? A whole bunch of people could be doing a lot of interesting things, but the world talks about it when there's money involved, right? Before that, it's just a figment of imagination or a bunch of crazy scientists talking about it. But when money starts to come in, everybody talks about it. The graph that I'm showing is actually a two-dimensional graph, but it's got two y-axes. On the left shows the amount of capital in billions raised by SPACs. And on the right, it talks about the number of companies that went public using the SPAC model. And you can see what happened in 2020. There was a tenfold increase in the amount of capital that SPACs could actually raise between 2018 and 2020 in 2 years. In the year 2020 alone, no less than $84 billion of investor money, your money and my money, was raised by SPACs. And that money was used to take 248 companies. That's the line that you see that's touching 250. 248 companies, private companies, went public using SPACs. So when something touches the 85 million mark, everybody starts paying attention. And that number has actually been already superseded when we are just through half of this year in 2021 already. So people started taking notice and asking the question, what is a SPAC? Next slide. Now, as I mentioned before, at Tozy Capital, our interest is to educate. So the only thing I ask you to do is to suspend your judgment over the next 10 minutes. Nothing is right, nothing is wrong, nothing is completely true, nothing is completely false. So let's take things for what they are. And what we are going to talk about today is what are the facts. Later, we'll talk about some case studies if we have time. So let's talk about step one of a special purpose acquisition company, the creation. Typically, there are three important aspects you need to understand about a SPAC. A SPAC is a blank check company. I don't want to use another three words to describe it. It's a shell company, a shell company. Now, typically people, when they talk about a shell company, always think about these, a shell company inside a shell company inside a shell company that's being used to hoard away wealth. A shell company by technical definition only means that it does not have its own products, it does not have its assets, it does not have any particular deliverable from its side. So a SPAC is just a company that's formed by high profile investors who could be backed by hedge funds and private equity firms. A bunch of them get together and say, we've created a company. It's a blank check company. Now, what is the purpose? The stated goal, the second point here of a SPAC is to raise capital so that it could be used to acquire a private company. Raise capital and acquire a private company. That is the stated clear goal. This process of acquiring a private company is called technically initial business combination. For people in the world of startups, you keep hearing the word, have they got through an exit? How many exits have you seen? Similarly, in the world of SPACs, they would say, we are focused towards an initial business combination. We are pretty close to an initial business combination. It's just a word, a term, which means to say we are close to acquiring a private company, and that is the goal. The third aspect is, unlike a traditional private company wanting to go IPO, a SPAC has a time frame. Typically, although it says 2 to 3 years here, typically a SPAC has 18 months to 24 months before which it has to acquire the private company. Why have I called it out as 2 to 3 years? If the SPAC actually files certain forms with the SEC, then it can automatically extend it to 3 years. So, but still there is a time frame. So the SPAC will raise money and tell the investors, within this time frame, I will acquire a private company and do you good, or you get your money back. So that is what is the sole goal behind the creation of a SPAC, and it is time bound. Next slide. Now, the most interesting aspect is, how does a SPAC go about raising money? The way it does is, it's a shell company. It doesn't produce anything, no assets. What it does is, let's call it the shell company XYZ. It just goes public to raise capital. It goes to the people. So the first thing that happens is the SPAC goes public. Now, of course, just like any traditional public offering, there are people who can get into the SPAC much early, and there are people who get into the SPAC later. So the earlier you get into the SPAC, the better, because just like any other offering, SPACs will give you stock, common stock in the SPAC, in the shell company. That's what you're buying. But it could also give you warrants. And I'll talk a little bit about warrants. For people who understand options trading, think of warrants as options to buy shares of this company later. You have some stock, but you also have some warrants, which means you can convert these warrants to stock later if things are going in the right direction. Now, typically the price of a SPAC unit or share is $10, but some are $20. I'll talk about a couple. So all that the SPAC is doing is, it's going public, it's got a ticker symbol, and it says, folks, can I have your money, please? Trust me, I know what I'm doing. Just give me your money. I'll buy a private company and we'll all get rich. That's all it says. And purely on the basis of trust, the track record of these sponsors, and the belief in their ability to have a good acquisition, investors go invest in a SPAC, a public company. The SPAC is public. Now, the sponsors really have a great time here, because typically what happens is, without any investment, they get 20% of the common stock. So actually, when you buy something for $10, your position is diluted and it's actually at $8. After fees and everything, it typically will go to $6.7 or something. But sponsors would get 20% typically of the common stock. Imagine they get all our money, but they take a lot of risk because they have to go find an acquisition. Their reputation is at stake, so they get to keep 20% of the common stock. They don't pay for it, but their expertise is what commands that 20%. And the more, the better track record you have, the more comfortable you are in getting 20% of the common stock. Now, the Spac is publicly traded. It still hasn't acquired a private company. Retail investors can now publicly trade the Spac. It's still speculation, but then you could have insider information. You could have other information in news saying that the Spac is getting closer to having an acquisition. So investors can actually trade the Spac publicly. But most of the interesting activities already happened very early when the Spac went public. Any further interesting activity is only going to happen when there is interesting news of an initial business combination or an acquisition, or an actual acquisition happens. Either there should be news or there should be actual acquisition. That's when further movement in the Spac price would happen. So that is step 2. Capital raise, sponsors get their share, Spac is publicly traded. Now we can buy Spac units. So that's step 2. Next slide, please. Okay, now what happens to the capital? Now, I talked about a time frame when the Spac sponsors have some time to actually go find a company to buy. What happens to the capital? Can they actually go put it in GameStop? Can they buy AMC? Absolutely not. The capital itself goes into a trust account or an escrow account. I think escrow account is more easy for people to wrap their head around. And it can only be used for acquisition. Of course, typically in the real world, what happens is the sponsor will take this money, put it in this trust account and invest in something super safe like Treasury, US Treasury notes, right? Which gives some amount of return. And whatever returns are coming out of it is typically working capital that the sponsors can use for any expenses and so on. But the capital cannot be touched for anything other than the acquisition. And the general rule is when the Spac buys a private company, at least 80% of this capital needs to be used to buy that company. So you cannot just say, you know what, I just keep all the money. I'm just going to put 10% of this capital to buy a small private company. So when they do a fundraise, they already know what kind of companies, what size of companies they are going to buy, because at least 80% of this capital needs to go into buying that particular private company. So that is what's happening to the capital. It's sitting, not doing much, which is actually a sort of con when it comes to Spac, but it's pretty safe and you will get it back, because in the previous slide we talked about in the time frame that's allotted to the sponsor, they either get you an acquisition or they'll give you your money back. So your money is actually pretty safe. It might not be doing something great. The second box is where now the sponsor is starting to search. And I use specifically a term, a lucrative target. They want to find that private company that would really pay back rich dividends for them and their investors. This is where most of the time the sponsor is spending their effort on. There are absolutely cases where Spacs go public. I'm talking about Spac going public, not the private company. Spacs go public having a particular company in mind. It happens. But today, with Spacs becoming so famous and capital being so easily available so far, most of these Spacs are what I call, this is my terminology, blind Spacs. They just raise capital and they say, you know what, we're going to find a lucrative target through our contacts. But there are some Spacs which I follow, which say, this is the sector I'm going to focus on. I still don't know which particular company I will acquire, we will acquire, but this is the sector that I want to focus on. So that's what they're doing. Now, you might ask, now this is super dangerous. A traditional company going IPO takes so many years. What happens if a Spac does not find a company to acquire and we reach that deadline? That's dead investment, isn't it? I'm just going to get my capital back with a little bit of interest. Now, obviously, there are ways and means around it. The Spac can, with the approval of the shareholder, extend the initial deadline. And this happens. I already know of 2 Spacs which have extended their deadline. This is very common, but it sort of reflects badly on the sponsor. So it's not a situation they want to be in. But imagine, I definitely want to talk about Bill Ackman's Spac, right? And I think it's one of the case studies. It's been a year, I think, since they've got $4 billion of capital and they haven't bought a company. But guess what? It's not easy to find a suitable target that's valued at 4 billion, because most probably that company would want to go public on its own. And I'll talk about what kind of companies would want to go with a SPAC. So this deadline is actually expandable. There's no hard and fast rule that you have to stick to it. Next slide. Thanks. Now, this is very important for all of us to understand. We talked about SPAC, we talked about the motivation. We know our motivation as investors, we want to make it big. We couldn't actually go work in a startup. That's okay. We couldn't actually buy a pre-IPO share. We are not big enough to be a venture capitalist. So SPACs seem to bring that aspect to the retail. That's us. But which company, what kind of private company would want to be acquired by a SPAC as opposed to going public on their own through a traditional IPO or through a direct listing like Spotify did or like Slack did? I'm going to present three cases. And again, you have to look at it philosophically. I'm not saying that this is what is true with one of the companies that we've heard about, right? Let's say there is a private company that is what I would call financially unhealthy. They might have high debt or they're really bleeding money on a day-to-day, month-to-month basis. For such a company to go to an underwriter and for an underwriter to back this company, go on a roadshow and spin a story saying, they're going to make money next year, don't worry, you should invest in this IPO, is going to be very difficult, especially if that company has some very strong personalities associated in the management. Now you know who I'm talking about. Virgin Galactic was this exact story. Richard Branson is not a person who's going to go easy on the investor or the investment community when he's on a roadshow. He was bleeding money, he was high on debt, but he had a great turning a corner story saying, I will make it happen in a year or two. So when such a company, which might not be able to convince the traditionalist by going to an IPO route, but still wants to have liquidity, still wants to raise capital, they might be okay going to a sponsor of a SPAC. Why? Because a SPAC sponsor is ready to take the risk, is probably understanding the nuances of this industry better, and is able to explain to the smaller group of investors the possibility of an upside, even though current situation, the financial situation is unhealthy. So that could be a kind of private company that would want to go public through a SPAC. The second that I've personally heard of is if the private company is in a sector which is obscure to understand. Think genomics, gene editing. If these are areas that the traditional investment banks or the institutional investor community is not that aware of, clear of, is not able to see the monetization potential, is not able to wrap their head around what kind of regulations will govern this sector, then they might be risk averse to actually participating in an IPO of such a company which is in an obscure sector. Whereas a risk tolerant SPAC, because SPAC sponsors are in it for the risk, higher risk, higher returns. Let's just try to understand, quantify the risk, and let's go all in. So a risk tolerant SPAC might have the interest and the energy and the enthusiasm to understand such a sector, an obscure sector. And then there is a marriage of minds, and such a target would prefer to go public through a SPAC as opposed to going through the traditional route. Another possibility is that the private company is in a futuristic domain. I mean, electric cars are just no longer that futuristic, but think about travel, futuristic travel, electric companies, future battery technologies. If they're working in a futuristic technology that is not immediately monetizable, that requires a lot of capital infusion, there might be questions in the minds of the traditional IPO gang to fund an IPO of such a company. Why wouldn't I just go to an Airbnb, which is already making money? Why wouldn't I go to a DoorDash, whatever money they're making, right? So why should I bet on this futuristic company when I have better options for my capital? Whereas again, a risk-tolerant SPAC sponsor might say, I believe in this technology. And you will definitely see that many of these SPAC sponsors are strong individuals who have very strong opinions, who want to bet big on certain things, and they also have an activist mentality. So these three are examples of maybe three types of target private companies that would want to go public through a SPAC. So we're looking at it from the company's perspective. And then step 5, next slide. So what happens? And this is when all the backroom negotiations happen. The SPAC sponsors are talking to this private company. Each one is trying to convince the other that this is definitely the right way to go. The private company is trying to push up its evaluation. The SPAC is trying to squeeze them and trying to get more roles in the future company, maybe board of directors. It's trying to squeeze them on the price, how many shares are on offer. After all the negotiation, they reach a deal. So let's be very clear. We said no underwriters in the direct listing. Over here, the SPAC sponsors are using people like underwriters to actually evaluate the deal to come to the numbers. So there is a hidden cost definitely involved here when we're talking about acquiring a private company through a SPAC. So they make a deal, and then in most cases, unless it's written explicitly, they will need to go to the shareholders for approval. Shareholders obviously are going to approve. Yes, but it's true that the shareholder at this point, and I've explained it in the second box there, the shareholders have the right to completely redeem their position. They could say, I invested $100,000 in this SPAC. I know it's been gaining some interest through the treasury bonds and notes that we bought. Just give me my money back because I do not believe in this acquisition. I don't want you to buy company ABC, but all of you, the majority holders, want to go ahead with this. So give me my money back. So early investors in a SPAC, but this is important. Early investors in a SPAC get to redeem their positions, or they can continue their positions. Whereas if you had bought a SPAC share in the public market, you are buying common stock, which is traditionally not redeemable. You just have to go with the flow. So when you enter a SPAC is also very critical. So this is when everything is fine, shareholders have approved, the marriage happens. And typically all the money that was sitting in the trust account flows to this private company. Now shares of the private company are purchased. Now they are rechristened as a new company, ABC, which will have its own ticker. And before you know it, next morning you wake up, and where you had this ticker called XYZ of a SPAC, you have a new ticker of a company called ABC, which was private till yesterday, which is now public. And all your ownership is now just transferred to this new company. Your money was actually given to them so that they could run their operations. Shares were bought instead, and those shares are now your shares. And ABC now is a publicly traded company. Guess what happened? During this process, and it's very important for us to understand, during this process of negotiation, ABC, the private company, could go out there and say whatever they wanted about their futuristic goals. We're going to go to the moon the next day. We're going to change the world. You don't need to actually eat food at all tomorrow because of our company. We're going to make everybody go food free. You can make any futuristic statements, whereas in a traditional IPO, if you're actually done with your form filings, you have to be super restrictive in what you're allowed to say. You're not allowed to talk great about your own company if it's going to influence the price of the stock. Whereas over here, because regulations are still not there, you could have the private company go to everybody, Tom, Dick, and Harry, and say, I can do whatever I want. The future is looking great. And your SPAC sponsors will also probably toe the same line. And now ABC is a public company. After that, it's the same story. How they perform is now based on the results, because now the S4 filings, 8K, all of those things happen. And now they have to go through all the SEC guidelines. This is what is a SPAC. A shell company started by a few people who have a lot of belief in acquiring a private company. They come to you and say, give me the capital. They find a private company. The private company also sees a benefit in going public through a SPAC as opposed to traditional IPO. The marriage happens, and this private company now becomes a public company overnight, and your capital has been deployed as part of this new public company. This is what SPACs are all about. Next slide. So again, we will be sharing this video. We are not here to say that SPACs are good or SPACs are bad. It's very important as investors and as matured investors, which is what I hope all TOSI investors are, to understand the pros and cons of every investment vehicle and make your choices. Always reach out to Eng if you have questions, because he talks to so many investors. So to SPAC or not to SPAC, if that's the question, you have to understand there are lots of positives. If you are a private company and if you want to go public, and you don't want to go through the hell that the underwriters will take you through, SPACs are definitely faster than a traditional IPO. As of 2021, today, there is lesser regulatory demand on what can and cannot be done during this acquisition process. So you can get away without doing a lot. If you are a private company, again, I'm talking to the company's perspective, you will meet risk tolerant sponsors who are ready to take the risk. So you will have more ears listening to you in the SPAC world. Now, if you're an investor, it is a time-bound investment. Of course, it can be extended, like I said, but more often than not, it's still a time-bound investment. So you can hope to see the light at the end of the tunnel. Whether it's the light of an oncoming train or it's daylight, that remains to be seen, but it's still a time-bound investment. And if you're really early in the SPAC, you have very favorable redemption options, and I can talk about that if there are questions. And if you're a sponsor, 20% for no investment, that's a great deal. So those are all the positives for a SPAC. Now, absolutely true, when it comes to the cons, a famous sponsor does not mean a good investment. And Eng's been one who's taught me that. Do not go for an investment. When I went to him for opportunity zones, he said, don't just go into opportunity zone because it's an opportunity zone investment. Go into it because it's a good investment. So do not get into a SPAC because it has a famous sponsor. Try to get as much information as possible on who their target is, what their motivations are. That's when you can really, really, truly make money. Because data clearly shows that post-SPAC IPO, the returns on a SPAC are comparable to any other IPO or any other high-flying stock. So just because it's a SPAC doesn't mean it's going to perform greatly. It's early investors definitely have an advantage, but otherwise absolute due diligence like you do in any other investment has to be done for SPAC. Just don't go there because Shaq O'Neal is there, right? Shaq O'Neal's got a SPAC is what I hear. Right? Everybody has got a SPAC now. So be very careful about the actual investment vehicle that you're getting into, and don't go behind a sponsor just because he's a celebrity, he or she is a celebrity. It is true that while it's time bound, the acquisition might never happen and you had a dead investment and your money just comes back to you. So be aware of that. Now, I just want to mention again, post-IPO investors in SPAC get only shares, not warrants. Warrants themselves can be traded in the secondary market, but that's a different topic altogether. But mostly when you're going and buying a SPAC share, what you're buying is a share, not a warrant. And we can talk a little more about that or Google it. There are some very good articles. Now, this is what is my personal question to the community itself. People can answer that. The more the SPACs, the lesser the targets that are available. There are only so many private companies out there. Now, if more SPACs, then we are going to be fighting for the same small set of interesting, lucrative targets, which means we'll be forced to make some decisions which might not be optimal. So that's something to keep in mind. And like I said, SPACs employ a lot of people behind them. So there will be fees. The fees are almost always hidden. Like I said, you buy a SPAC for $10 share, early entry. Your position is more or less at the $6.6, $6.7. The rest is all going into the sponsors and fees, which is fair if they're actually going to return your money. I just have one more slide. Sorry for the delay. And last slide. Yeah, my final slide. What's the verdict? So these are some of the headlines that you will see. Google SPACs, and this is what you will see. It also depends on what you Google. SPACs, how awesome they are. SPACs, why they suck. It depends on what you search for. Forbes says why SPACs are here to stay. Crunchbase was talking about, investors absolutely see benefit in blank check companies, which is SPACs. And then there is, of course, buyers beware. This is not good. SPAC founders don't make any money. All kinds of stories come out. But I want to focus on the last one. And this has been my biggest investment learning over the last 15 years, meeting people like Eng and other teachers who have really helped me out. And I want to just share a small story. In the 1920s, mutual funds came into being. And they are said to be the reason for the crash in 1929, the depression. But later, they became more mature. And in the 50s and the 60s, mutual funds, and even today, mutual funds are considered a very stable investment vehicle. Credit cards came into being in 50s, in the 60s and 70s, way before our time. Apparently, there were stories in this country where fake cards and fake regulations and all kinds of scams were happening around cards. And people said, no way plastic is going to replace paper money. But we all know what credit cards do in our life. Similarly with junk bonds in the 90s, and there are actually very good investments possible in junk bonds if you know what you're doing. in the 2000 CDOs. The credit default swaps have an underlying packaging called collateralized debt obligations. CDOs are what they are called. They are the ones primarily called as the culprit for the subprime mortgage crisis. But CDOs, if you understand the actual science behind it, are a very powerful investment product. So the takeaway that I want all of us to leave with, if that's possible, is what we believe is SEC will bring in more regulations around SPACs. So in the future, SPACs will be fewer in number. They will be regulated, but they will be better. But do not dismiss Spac, because they have just done an incredible job of opening the possibility of making these three people ambitious, powerful sponsors, eager investors, and private companies which are going through one of the states that I was talking about, bringing them together to make investments happen and to make high growth happen. So they serve a purpose. They will get better with time. Focus on the basics, talk to your friends, talk to experts. And I think SPACs, in my opinion, are here to stay as long as we use them in the right way. Back to you, Eng. Thank you so much, everyone.
Thanks, everybody. I really appreciate Shiv for telling the story of SPACs. I think one of the things that highlights is a lot of ways to invest, and there's always people trying to find value in private alternative investments, private companies in this case. I have definitely explored setting up a SPAC myself. I have friends who work as principals of SPACs. Some of them have been waiting for several months, just looking for target acquisitions. They even reached out to me, say, "Do you have anything 100 million plus that I can acquire? Anything at all?" It's very funny.
And there are some questions. We have 10 minutes. Should we take the questions?
Yeah.
Since some of them are SPAC related, maybe I can take them up, but feel free to chime in from your side as well. An investor asks, actually, it's a very interesting question, and this is something that we have to clarify, right? What kind of incentive does a SPAC sponsor have to acquire a good private company, given the SPAC sponsor will get 20% of the raised money anyway? That's not true. They don't get 20% of your money. They get 20% stock in the SPAC. And as it buys a private company, they will get stock in that private company. If they don't, all of the raised money comes back to you minus the fees. So they don't make any money. It's dead time for them. So they have every incentive to actually go make an acquisition. In fact, I've heard people say that there are sponsors out there who would rather make a bad acquisition than give the money back. So I think they have all incentive to make an acquisition. Take what I said with a pinch of salt, but that's what it is. Are SPACs listed on the exchange before the merger? Absolutely, absolutely. Let me try to remember the names. Nicola comes to mind. I think it was called Vector Acquisition IPO was the name of the company. Here is a good example. IPOA was a publicly traded ticker, IPOA from Chamath. And this, you could buy IPOA stock on the market. This was a SPAC. IPOA later bought a company called Virgin Atlantic. And post-merger, the new ticker symbol was SPACE, SPCE. IPOA just disappears. Mm-hmm. So yes, you will see them publicly traded before the merger. Absolutely. That is the purpose why they are there. And after the merger, you will have a new ticker symbol and will continue to be traded. And I just need to, another example. Yeah. This is an investor talks about IPOE. IPOE is the fifth SPAC from Chamath, is now Sophie. I don't know if you know Sophie as a company, but so that's another example. I'm just going to take a breather, Eng, to just go through the questions. So there might be some silence.
Johnny asks, will Tozy ever create a SPAC, perhaps for a real estate company? So real estate generally don't aren't acquired by SPACs. I think if you create a technology platform around a real estate company, potentially that could be a target for a SPAC. I think most real estate companies use REITs to go public markets. I have definitely inquired on a SPAC for Q1 2022 to potentially take Terrace out public. So there's a few examples of SPACs happening within the Bitcoin mining space.
Just a couple of names that you can see popping on the chat window as well. So IPOA was the ticker symbol, but absolutely Johnny is right. It's just that it's very difficult to pronounce. The name of the SPAC itself was Social Capital Het Sophia Holdings, which is what actually Johnny is presenting. If you're actually interested, definitely Google this one, PSTH. P as in Peter, S as in Sophia, T as in Tom, H as in Harry. PSTH. Pershing Square Tontine Holdings. Bill Ackman, people who know Bill Ackman know him, otherwise he's a hedge fund manager. He has a SPAC, ticker symbol is PSTH, $4 billion raised. And I think it's more than a year and no acquisition yet. So everybody is a little bit edgy about it. So these things happen. Let me just look at the other questions. Does SPAC sponsor involves investor via voting process before acquiring a company? So it is all in the details. Typically, when you're actually buying, entering into a position of the SPAC, they clearly mention how much of shareholders how much do the shareholders have a say in the decision of the company. But in all probable cases, there is a voting process in which the shareholders have to approve the acquisition. How much in what aspects of the acquisition do you get to voice is different, but there is definitely a voting process. Is every SPAC set up to always acquire only one company, or could a SPAC end up purchasing multiple small private companies? See, this is where, Eng, do you happen to know the answer of this? I will give the answer to the best of my knowledge. So my practical experience aside, I do not know theoretically, it is always 1:1. In fact, the rule says that you can raise capital and 80%, at least 80% of that capital has to be used to purchase one company, right? So it happens both ways. It has to be big enough company and it has to be only one company. So it's normally 1:1. I don't know if there are other rules where people can work around it, but this is the typical scenario.
It's almost always 1:1. I don't think I heard of anything more. I think some SPAC managers actually have multiple SPACs. So I think they're very specific to targets.
I see. An investor asks, does the SPAC sponsors shell company go through the same process that a traditional IPO company has to go through? In that case, the shell company would also need the same lengthy process and long timeline. Mm-hmm. Two aspects. One, no, they do not, because there are three aspects to it, right? What are they promising their investors? And what kind of financial history and financial numbers do they have to show to an investor? If you look at it, a shell company shows nothing. Whereas if you are a traditional company that wants to go IPO, you are manufacturing lemons or whatever it is, and you want to attract investors, you have to show three things. What am I doing? Where's my money going towards? Expense? What's my growth? What's my plan? And most importantly, who are the owners and what are their intents behind it, right? All of this have to be filed publicly. And this is available for everybody to see. Whereas in a shell company, what are you saying? He's saying, I don't know. I just want to buy something. Trust me. So while it might seem that they are similar companies, what a SPAC has to do to go IPO is intrinsically more easy. I hope that answers your question. An investor asks, you're saying that 80% of the capital should be, at least 80% of the capital should be invested into this single company, purchase of the single company. What happens to the rest of the 20%? Right. Again, these are things where actually when I get more mature to that stage, I will know how it's distributed. My harebrained tells me that the money comes back to the investors in some form of the other, right? That's what it is, right? It's your money after all. But the exact means, does it come as shares of the new company or does it come back as dividend? All of those things, I haven't been there yet. So I'll let you know once I find it out. What kind of due diligence of the SPAC do you recommend to do when the sponsor has not yet shared the name of a target company? 95%, 99% of these SPACs is not going to tell you what the target company is because most of them don't have one. So what kind of due diligence can you do on a SPAC? Very good question. The answer is none other than track record of the people. How have they been in their past when they did traditional IPOs, when they did traditional mergers and acquisitions, when they did exits? It's purely track record. Just like when a fund manager, right, when Kathy Wood started ARC, right, it's purely based on the power, the charisma there, the trust that they can evoke that you're going. After some time, when this market becomes more mature, you will look at track record. This person has actually had 5 SPACs that did these acquisitions and they did well. But mostly right now, you're going based on your gut feeling on the sponsor or maybe 1 or 2 people in the sponsor. That's why you got to be a little bit careful. An investor asks, SPAC units are pre-IPO? I'm not sure I understood the question. Yes, SPAC units are pre-IPO. After that, typically they're called stock or warrants. That's correct. We are at the top of the hour, Eng, but should we take the questions?
Yes, let's just wrap it up. I think.
Yeah, I hope it was useful. I mean, it was just information sharing. I know this is not as interesting as some of the other things that Eng presents, where we actually have an investment to talk about. An investor asks, does every investor get the opportunity to vote to decide purchase of the target company or only selected investors? All of us, all of the investors, your shareholders. Mm-hmm. How will one be an early investor of a SPAC? Just like how you become an early, as of today, right? You're talking about the early investor. As of today, early investors in SPAC are like early investors in any other private equity fund. You need to know people, you need to be one of those investors, and that's how you get in there. And a question for you.
Is Tozy going to focus on pre-IPO share investing? Did you already discuss Impossible Foods? I did not discuss Impossible Foods here. The intention of this was necessary to discuss Impossible Foods. As some of you guys know, we have an offering for Impossible Foods. It's a very small offering. We've done one for SpaceX a few weeks ago, and we'll continue to do these as we find stocks or companies that are, I think, have really high potential value and where we can have access to. So I think this is something that Tozy will do on occasion, but won't, it won't be a main factor for you.
Got it. On the chat window, an investor asks, an investor says, this is great info. Thank you so much for doing the research and sharing with us, but would love to hear something actionable investors can do, which is right. We completely agree with you. Are there specific opportunities you can point us towards? See, Eng, I will cede the answer, but then you can continue. When Eng and me were talking about it, should we get involved in SPACs? The first step always is to look at investor appetite, right? We wanted to share what we believe is the current lay of the land when it comes to SPAC. And obviously, when more of you want to talk to Eng saying, hey, you did that webinar, what's happening? Are you getting into any SPACs? That's what gives him the interest. So our hope is that we'll bring back something actionable to you. But as of now, stay tuned to what's happening in the SPAC world so that when something comes from us, you'll be able to latch onto it. Eng, did you have anything to add?
No, I think this is, I think SPACs have been very hot, and I didn't want to necessarily dive into the SPAC space until there was a little bit more understanding of, what the good ones are and the bad ones are. And I think over time, we'll figure out that SPACs have been hot in 2020. I think it's less hot this year. But I think I really like waiting and seeing to shift through and get better data for our investment opportunities.
Okay. Is that all? Have we answered everything?
Yep.
Okay. Eng, personally from me to you, thank you so much for giving me this opportunity. As always, enjoy being on a webinar with you. Thank you so much, investors, for your time, for your hour today. You will definitely have the recording available. The recording in this case will just serve to stimulate some ideas and thoughts in your head. And thank you so much for your time with us. And with that, I hand off to Eng for closing remarks.
Thanks everybody for attending and listening to us explain some topics that I think aren't directly related to what we've done in the past, but are still very related to investing in alternative assets and equities in a Spac and IPOs are definitely alternative asset investments. I think that's something that we will continue to pursue for everybody. I really like to hear feedback from investors as well. So if you guys have any feedback or comments on something that you're interested in that we've had mutual interest in, I'd love to deep dive into it and present to you. With that, I appreciate everybody. Thanks. Shiv, you have the last minute.
Yeah, I just want to add one thing because an investor asked, what is Tozy focusing on these days for investments? So I also want to share one thing about the investment portal that Tozy has. So you should be getting newsletters from Tozy on what's happening. I think the latest newsletter that I got had a wealth of information on what we are focusing on. But we also realized that a few investors could probably have their settings such that you do not receive the newsletter. So make sure you log into the investor portal and turn on the settings so that you will receive the newsletter and the company updates. But the latest newsletter has a lot of detail on what Tozy is focusing on. But did you want to talk about anything specific, Eng, for our investors?
No, actually, one thing that we'll probably do this month is we're going to have an investor all hands where we can really talk to our current investors. And then also we'll talk, and then a wider investor webinar where we'll talk about all of our deals and, love for it'd be more of a Q&A of just asking us what, how are we thinking this deal versus that deal? It's harder to say, of course, there's different risks and profiles. We are always working on new deals. Mark Riesman just joined us a few weeks ago. And we're just had an investment committee meeting today where we looked at 6 new deals that we have potential targets on. So excited to potentially provide those. Obviously, those take a lot longer to mature and with Impossible Foods, that is available on the portal now. We'll have the offering documents for that ready in probably in a week. Again, thanks I don't want to take too much of everyone's time. Thanks for coming again on a Tuesday night. Appreciate it.
Thanks, everyone. Bye-bye.
Bye, guys.